Oh, there's lunch too?
Yeah, there's lunch, and then you've got assignments, so once you get situated, you could just sign in.
Cool.
Hi there.
Hey there.
Hi. Any seat, grab some food, and then once you all get situated, we have to sign in.
Okay, okay.
Under the loan officer column, just if you're currently working with any Pilgrim LOs, let us know. Otherwise, you can leave a blank.
There goes my lunch.
I know, getting these things ready is always so tough
That's right.
because I smell all the sweets.
You don't mean you don't eat any?
Sweets? No, I try not to.
You're smart.
Special occasions.
Huh?
Said only for special occasions.
You're a smart woman. So yes, I did stay away from anything, the white syrup, white flour, white salt, you know?
Yeah, absolutely. My part-time gig is at CrossFit coach,
Oh,
so super into the, yeah, I know, unfortunately. Yeah.
So do you do any like regulars or anything like that?
Actually, just this past October, I did the Ragnar Trail Run.
Which one?
Ragnar, so it's like a team of 8, you run 150 miles relay style.
That's pretty cool.
That was not my funnest.
No?
No, well, I mean, it was fun, but you know, but mostly it's just how I get in shape.
Gotcha.
So, yeah.
Have you heard of along that line? There's the time death march.
Yes, actually, we had a team go.
Really?
Yeah.
This year?
We had a team go, I think, maybe a year.
Okay.
Just about.
I'll be there. I'll be your team.
Awesome, how cool.
And that's why I asked you if you do
Awesome,
those type of
optimistic.
things.
Yeah, I don't, but we have a big group of
How
people
about
urgent.
top runners and Spartan?
I'm doing a Spartan this Saturday.
Oh, you're doing the, see, I couldn't do the one this Saturday because of the time.
Oh,
Because I'm on Alberto, so I'm doing the ones in May.
Oh, okay, yeah, I'm
I want the
excited.
trifecta.
Oh, okay, yeah, this is my first one, so just kind of seeing how it goes.
If it's good, look up the trifecta, because you get the medallion.
All 3, yeah. So it's gonna be down the hall, hi there, so if you go down the hall, you're gonna wanna go to the right, it's kind of a little maze, and then to the left, once you get to the
I remember
there.
this building when it was a church.
Hi. Go ahead and get yourself some food, get situated, and then we have a clipboard going around for you to sign in.
Oh, thank you. Thank you.
Under the last column, if you're currently working with the Pilgrim LO, just list their name. If not, you can just leave it blank.
Oh.
Yeah, get that on film. We can tell you a little bit more. Okay. All right. Hey, everybody. Hi there. So have you figured out how to use the QR code little thing yet? Okay. And this is just an easy way for us to capture electronically that you're here. But you open the camera app on your phone, and then just view the code. You don't even have to snap a picture, and then a link will pop up that says, like a Safari link if you're on Apple, or a Google link on your Android phone, and then you tap on the link, and then you can type in, is it working? And then you type in, yep, name, TREC number, all that stuff. Let me know if you need help, because I can help.
You also have a class on how to get a QR code?
That could be a class, but it's pretty easy. It sounds pretty nifty. You are, it's just a hyperlink. So, and there's a website called Free QR. You can put an email address in it, you can put a website. You can, create a QR, put it on the back of a business card or whatever. Yeah. It's great if you have a really long feed. Mm-hmm.
Right by my San Antonio on rightnow.com. We've all seen it. Or especially, like you said, for emails. Yeah, for emails too.
Yeah. Just open the camera app and just point it at their, you don't have to take a picture.
Just the camera?
Uh-huh. And then once you've done that, then the link pops up. It'll link pop up.
Oh, do you first sign in right here on this?
Yeah. Yeah, the TREC says that we have 10 minutes on each hour.
Yeah.
For writing, whatever. So we'll get it.
Yeah, okay.
As long as we get the, but I have got to talk about that it fills up that time, no problem. So, and usually lots of really good questions too, so. Yeah. Or you could, if you look behind you, there's one right behind you. Okay.
No, you're fine. I just want to get the trash.
I think we'll scan
That's
it.
it, there is. Okay.
You got any little sanitizer over here too?
Restrooms are down to the left, and then there's a door to the right. They're on the
I
other
think
side.
that's have enough time to go ahead and do that.
Yeah.
That was the combination you right
Oh, yes, because all of the modern.
It's not working. Where's this?
Let's try it one more time.
So are you doing the super?
Oh, you actually took a picture. I'm doing the super.
So then it's more
You
distance.
have to take a
Yes,
picture.
like 6 miles.
Yeah.
See, and
Oh, no,
if you
you
do
don't.
that, then you can certainly do the spread.
Yeah.
So the only thing you gotta have in your head is the beast mode, and
There you go.
you
See?
get the trifecta.
Hopefully we'll see how this weekend goes.
If you like it, I don't know if they'll let you do, I think if you do, all you do 3 and 4 years, you get the trifecta.
Yeah, yeah, I think that's.
You'll see how you do. I wanna know,
Well.
I'll give you my colleague, let me know how it works.
Yes, absolutely. And I'll,
Is it looking on?
I'll-
We made you.
I'll let you know your name is on.
Oh, okay.
That would be cool.
Maybe let's do it one more
Because
time on your
we
phone, and then she
just go
can
in,
just sign
right,
it
so
directly.
we're gonna let one person pick up packets for everybody,
Oh, I
but
see.
because of that, every person who's gonna get a packet has to pick up themselves.
Oh, wow, yeah.
So it's a new
Yeah.
procedure.
I think I'm sure you will leave it. Okay. It's kind of fun.
Oh, you want to?
Was your sign-in sheet?
Yes, I've got one on a clipboard being used right here, and then we'll get it passed down.
Did you need the sign-in sheet? Did you need the sign-in sheet?
Yes, please, thank you, sorry about that.
That's okay.
food. Once you get situated, we have a paper sign-in sheet, and then if you open your camera and point this QR code, a link will pop up so that you can sign in for your CE.
Okay.
Well, that's different.
Nice to see you again. How are you? Has anyone heard about the recent rate environment?
Awesome.
Yeah.
The what?
The rates?
The rates? No.
The buzzword for today? Well, the second buzzword for today, right? Buzzword one is credit, two is rates. Anyone have any questions about the rate environment? While we're here, I'm Lisa Arlette, by the way, mortgage lender with Pilgrim, one of the LOs. Have any questions, any clients asking about the rate or how it's impacting?
Everybody's refinancing.
It is, that is true. People are refinancing, but the flip side of that is too, we've got a lot of pre-qualified buyers ready to go buy a house. So what should the message be for the sellers? Get your house on the market. You know, the rate is all fabulous, but unless you're able to actually like implement it, boat has sailed. So if you've got people that have been in touch with you guys about maybe wanting to sell their house or whatever, use the rate conversation to help inspire them along. Tit for tat. They need somewhere to go to. Right? And now's the perfect time because not only it's like the high, you know, the culmination of a lot of great factors. One, we're heading into spring season. Right, so it's naturally a selling season picking up anyway because people are trying to make moves and get their family settled before the summer. That's usually the inspiration. A lot of corporate relocations and military relocations happen during the springtime too for the same reason. And now we've got this tidal wave of the rate environment happening too. It's like a magical, unlike anything that I've ever seen, combination of circumstances. So if you need any help with those conversations with your sellers, I often, not live, I don't speak with the sellers, the only reason often I talk to the buyers, but I do have conversations with sellers. I have found that for my realtor partners, it helps with their listing presentation if the sellers also see what their next steps could be. Does that make sense? Like if we can get them comfortable with what it is that they're going to end up with their proceeds, and how it is that they can apply that for their next step. They'll have a lot more calm conversation with your listing. If should you need to have a price reduction or to talk through negotiations, because they already know what the next step looks like. So I would encourage you, if that's not mine, is it? I would encourage you to reach out to your Pilgrim loan officer to engage us in that capacity too. We do not just work on the loans. Pilgrim as a company is very relationship focused, and that's definitely how I roll too. So please utilize us in whatever capacity it is we can help support your business. While one of them, most of it, will be to close your buyers. You can consider us a resource in your little peripheral areas too. Did that inspire any questions? No? Good. Thank you. While we're still waiting, I'll just keep talking because, you know. So another thing that I would, that's often a talking point that is kind of overlooked at, especially in San Antonio with, you know, being so hot and heavy with the flipping right now, right? Everyone wants to be a flipper and, or buy flipped properties, right? Because you don't have to deal with the permits and they've all got that agreeable gray, and who doesn't love an agreeable gray? So that's why it's agreeable. So I would encourage for your folks that are entrepreneurial, this is not for your standard listing person, but like the folks that are going to be the next HGTV star. I have worked with several that use hard money lenders to buy the property. Am I a hard money lender? No. But you don't want to stay with that hard money lender because it's not pleasant terms. So how I've helped quite a few of my clients that are of the investment breed, they'll buy hard money because that allows them to be competitive in the market, right? Usually the price points of investment properties are such that you're going to be against cash offers. So having a 30-day closing conventional financing, FHA, heaven forbid, on a property that's trying to flip isn't going to work. You're just going to be spinning wheels and spending your weekends showing properties that you're never going to be able to cash. So going into the hard money realm, and everyone here knows what hard money is? If not, I'll give it a, yeah. How are we on time? Feel free to cut me off.
Yeah,
Where's my
we're good. 5 minutes or so.
Everyone here knows what hard money is? Okay, everyone familiar with the terms of hard money? If you're not, it's, so again, I'm not a hard money lender, but I've worked enough on the other side of it to see what their terms are. So I typically see the cost for a hard money loan to be 1 to 3% origination. So again, this isn't me, this is them, but that's their profit, right? I mean, they're the ones that are at risk. So that is how they offset the risk, is with the origination fee. The interest rate usually varies, that I've seen, between 10 and 13%. Yes, it's a short-term hold. If it becomes a long-term hold, your folks are going to have an issue. So that is why it really is a strategy throughout for my folks, because if you're going in with the hard money, you better have an exit plan in place. So I've got at least 3 investors now who we've already outlined a rough draft their exit strategy, and they're out making offers with the hard money. So what does that work like? So usually the hard money lender will lend for the purchase, and then also lend for the improvements that they do an appraisal version. So say the house is selling for $60,000 and they figure $40,000 in improvements, but it would sell for $165,000. So they use some sort of schematic to come up with whatever the improvement is. So the borrower is paying the 3% and the interest on the $10,000 that they're borrowing. Okay? So then what happens on the tail end of that is that we then refinance them out of that hard money lender. So now they have a regular investment property in traditional terms, and the 20% that you would need for an investment property has been the equity that's happened from the $60,000 purchase, the $100 improvement, and now the appraised value for the $165. Pretty fancy. I like it. I'm a fan. One thing that I would keep in mind is that for those folks that are considering that, it's also very much a price point for FHA buyers. Right? FHA buyers are going to be oftentimes in that price range, and FHA requires there to be a 90-day gap between title changes. So help your investors not get stuck.
So for an investor that would, where do you get, if I say, oh, here's where you can go for hard money loans, where do you have is there a list, or?
There isn't, so it's completely not me.
Right. I know it's not you.
Not me. Personally, yeah, I'm not a fan of hard money, no, not really. It really is a great way to get from A to Z in certain circumstances. So there's been a couple that I've had personal experiences with just via my clients, and that is Lone Star Investments. It's here in town, Jade something. If you Google Jade and Longhorn Investments, they do regular presentations here in town, and I really like their model and their presence and what they do for their clients, at least from what I see from my end. So that's
Any
enough.
others that you? Okay.
So now, the real reason why you're here. And so, welcome to Pilgrim Mortgage. Who here has had transactions with Pilgrim? And raising high, I can't see. And is that as buyers?
I have one right now as buyer.
Perfect. And then who here has been on the listing side? Okay. So, part of the reason why we hold these presentations is the same thing that you would be incorporating as a realtor into your marketing strategy, which is to provide exposure to who you are and how you are. So that is us for you. Welcome to Pilgrim. Welcome to our home. Credit obviously is a big part of what we do. And the reason why I'm so glad that you guys are here is because you understand and value how much credit impacts your client experience. I will say too that if there's any folks that have any private inquiries or private mortgage plans too, I'll be on site after the class if you want to pop by, if you'll let either me, Susan or Jordan know so that I can slot my appointments accordingly to make room for it. Happy to help. I've been very fortunate to help 4 realtor partners with their own personal businesses with their own personal financing within the last 3 months. So if you don't have a Pilgrim mortgage lender, we all vary by personality, by communication style, but we all have a fabulous engine behind us that is Pilgrim. It is grassroots, it's family-based, it is relationship-oriented, and the Pilgrim boys is what they're called. The Pilgrim boys are absolutely committed to bringing on loan officers to help our San Antonio and our Texas markets, and we have now actually expanded outside of Texas from a genuine, wholesome, helping people place. So if you haven't worked with Pilgrim yet, for obvious reasons, I'm a fan, but I also picked to come to Pilgrim just like you decided where to hang the replicas. I do the same as lenders, and it makes a difference in your client experience. Back to credit, which is the reason why we're here. Who here works with buyers? So all, okay, that's great. I will say there are probably 2 uncomfortable conversations to have with your clients, right? One is, are you pre-qualified? Please call my lender. I would recommend not phrasing it that way. I would recommend let me have my lender call you. Slight year difference, but it sets a completely different stage. Let me have my lender call you. Secondly, if they say, no, I'm not ready, or no, I'm saving, or well, my dad told me I'm not ready yet. It happens. It happens. That's like real conversation. My dad says, well, your dad was also paying 60% interest when they had to have, 20+% down. Dad does not know. I happen to know, so feel free to send them my way. I will also say, and this is probably the thing that is most upsetting to me, just from a personal place, is that Google is so easy to access. Any online search engines, you search credit repair, credit this, what do I need to get a mortgage, anything. And while clients may think that they are doing self-education, they are doing so much harm and damage potentially because they're self-analyzing, self-qualifying, probably qualifying themselves out of buying and renting for another, year? So somebody got a calculator on their phone? You all got your phone. Somebody pull up a calculator. All right, so average rent in San Antonio is $1,800. Would you say that that's fair, whether it be apartment, we're talking a usual family, a couple with 2 kids, 3-bedroom, law, about $1,800? I mean, we know that they go for well over, but is that at least an average? $1,800. So if we've got a client that is thinking, I want to move during the summertime, so let's say that they would be kicking the tires around, January, February, Googling online and self-critiquing their credit and they're qualifying to get the best deal. So their lease is expiring in May. So they're now kicking the tires of Google searching January, February. And they have ruled themselves out of buying, and I'll show you an infographic here in a minute of why it's so important, and have renewed their lease for $1,800. So now they've paid 15 months worth of $1,800. And how much is that? $27,000. $27,000. Now, maybe it's a very simple tactic for you as a realtor to have a conversation with your tenants. You want them to have the full impact of how much money it is that they are spending on something that isn't theirs. Does $27,000 make an impact for you as you hear it? That's 1 year. So here's what's happening with your folks that they're not going to tell you. So I Google every now and then, just like I'm a consumer, right? Because I want to know what it is my clients are thinking before I visit with them. So I found this online. Looks real official, right? The complicated relationship of credit score and real estate. Are you ready to settle down? Less than 640 score. This is what this infographic says. Less than 640 score. Sleep on the couch. Do you think think your client is gonna tell you, I'm not ready, I've been told to sleep on the couch? No, they're not gonna give you the opportunity to say, well, that thing is crazy, what are you listening for? And they are so embarrassed and humiliated, they will just tell you, you know, we might be money to save, give you all of these things, but the real thing is, they've been all day, every day. So they have spent nearly $30,000 excuses, call it a purchase planning consultation, call it whatever. Now, while the score may be legitimate, and they on a credit repair, some of it's legitimate. Some of it is absolutely illegitimate. So if they haven't paid their car and it was repossessed last week, okay, maybe. But for those that are on the verge of, you've got to give them a chance. They don't know that they've got a chance unless you tell them, because you're the front line of defense. You think they're going to call me first? No, it's your sphere. It's your clients. It's your contacts. Give them a chance. Give them a light at the end of the tunnel. Say, you know what, even if you're not ready now, let me connect you with my lender, and we can put a purchase, or she can put a purchase plan together for you. That just completely took the pressure off. This is not a next month thing. They did not hear you say pre-qualify, get your down payment together. What they heard you say was, put your purchase plan together. Isn't that a gentle way? No pressure. And then for me, if they really are challenged credit-wise, I give them a silver lining of hope from, you know what? We're going to get you into a house. Might not be next month, but I know what we can do. Do you want to answer the credit questions? I don't recommend it. I don't recommend it. Let us do that for you. And then trust us. Like if you have your lender relationship, trust your lender because you're trusting them with your food on the table too, right? Trust them to make sure that they can get your clients where they need to be. And for us, it's relying on resources like a credit repair, if it really is not workable, to get them to a place it can be. Because you know what? They deserve it. They deserve it. They deserve a home. They deserve the time. They deserve the attention. So let us give it to them. So without further ado, if you have any questions, I'll be around. But I pass the baton and really appreciate y'all's investment in spring to be here to better your clients.
Thank you. Thank you very much. All right. Well, this is Credit 101 for real estate, and you've done a great job at presenting the problem, which is that person that says, oh, I'll just rent. And that's the reason why this class for realtors for us is just that's going to empower you to help your borrowers understand what their credit score means, why the score on that, you know, and be their trusted advisor through that process, right? So we're gonna tell you all about credit for mortgages, about the different parts of a mortgage credit score, the industry differences in scoring, about negative items, collections, all of that we're gonna talk about today. And our lender's gonna be back kind of at the end to answer more questions, and talk about anything else that you guys, that you'd like to talk to someone that has NMLS by their name, which is not me. But this is who we are. Chris and I, we're a brother and sister team. Chris has been in credit repair over 12 years in Texas, worked on the corporate side of things for a long time. I've had people in class go, wait, I know that guy. He used to work for that XYZ credit repair company, but now he's the owner of his own company. And the reason why is because he wanted to build a relationship-based company that leads with education and growth opportunities for people, not as a way to just, you know, build a great big corporate empire, right? And so that's why we're here. I stepped on in the company and left my teaching career about 2.5 years ago and haven't looked back. I've been really excited to help the company grow in this way and be that sort of the lead educator out in the field, helping realtors and clients, business owners, you know, understand credit and how it impacts what they're trying to do. So if you, let's see, let's back up a little bit. If you have not signed in for the class using the little QR link, let me know and I can help you with that later. But otherwise, that's how we're gonna get your TREC information too. All right, and if you have questions during the class, things that come up, things that you want to know about, you've got my business card on the packet. Did everybody get a packet? Did you get one? So keep that handy. If you have a question, you know, like, hey, Susan, can you take a look at this credit report right now? And that happened in the middle of the class. We might want to save that till, you know, after the class, or, you know, or text me, and then I'll, you know, when I'm driving back to Georgetown, we can talk while I'm on the road. But if you have a real specific client question, something involving kind of sensitive stuff, save that number, and then, you know, we can talk later and debrief.
You're out of Georgetown?
I am.
Both your brother and you?
Chris is not. Chris is not in Georgetown. He lives in Colorado, actually, but the company is in Texas. And he remotes in and spends about a week a month here. But that's where his family is, his wife and kids. So, yeah. And our mom lives in Texas. So,
Exactly.
yeah.
You're gonna have a client, they can't meet you in person, please.
We don't often meet our clients in person, honestly. People are busy and we spend a lot of time on the phone. And so there's not a lot of need to actually shake hands, but you know, but I'll take an invitation to a housewarming party though anytime. And we have gotten those kinds of opportunities to, you know, finally meet our clients. Hey, come on in, we've got some stuff down here. Okay, so let's just start and talk about what's in a credit score. What's in that number? I'm not sure, but I know that there's a spot right down here. Oh no, that one. Okay, great, perfect. Okay, so you can follow along and take some notes. Okay, so a credit score is not just a number, right? It's actually 3 scores generated by the information at the bureaus: Experian, Equifax, and TransUnion, right? And you know when you're pulling up a mortgage credit report that they're going to drop the high and the low, and they're going to look at that mid score. But why are those numbers so different? Any ideas about why those numbers on a credit report, like a mortgage credit report, are not the same?
Mistakes.
Mistakes, yes, very often.
Just the way that they're reported, who reports and who doesn't.
Who reports and who doesn't, right. Okay, so you might have a medical collection on your TransUnion credit report that's not on your Experian and Equifax, right? Right, so that might really negatively drop your TransUnion score, but then it's not affecting the other two, right? Okay, so different information. Not all creditors report to all the bureaus. We also see sometimes that credit cards don't report on the same day of the month, okay? And this is really important. So like you get a Capital One card and they report on the 1st to Experian, right? And then maybe they report on the 18th to Equifax and TransUnion. We see it a lot. So if you're like most people, your credit card balance might not be the same on the 1st or the 18th, right? And the score that's generated from that information really is different. So if you have a nice low balance on the 1st because you just got paid, right, and everything, you know, balances are low, it's a nice rosy picture, the score that's generated is going to be nice. It's going to be a higher score. On the 18th, if you've just run up all of your expenses for the month, right, website, email, you know, all of those things, and your bill is now really high, then it's not as rosy a picture, and the score that's generated is going to be lower. So you might have really big differences and swings in there because of that. But the big picture reason why scores are different is that they use different algorithms, okay? And an algorithm is just a big word that gets thrown around a lot these days. We hear about social media. Facebook has about 1 million algorithms in it. It's an algebra problem, right? It weights different things. And so that's what a credit score algorithm does. It's an algebra problem with different percentages for the different indicators about you and your borrowing habits, okay? But in reality, there are over 100 different methodologies used to compute a credit score. And I usually pause for effect there, let that sink in what I just said. 100 different ways to compute the credit score. So you may have been thinking, okay, she was leading me up, there's all these different algorithms, but there's 3 credit bureaus, so there's 3 algorithms. Okay, I got it, right? No, 100 different algorithms, okay? And as you're speaking to your borrower about credit, they're accessing their credit score from their phone, let's say it, right? From the what? From their phone, right? They're accessing their credit score from their phone, right? The bank app, their Discover app, if they have Credit Karma, right? Those different kinds of places, right? And the credit score that is generated there is not going to be the same that a lender is going to pull, right?
Yeah.
Okay, right?
How do we get them to, when we tell them that, they're like, no, it's accurate, I have Credit Karma. How do we get them to?
Well, you could be sarcastic, it's not a relationship building. I say, is Credit Karma gonna loan you that money? No, I mean, that wouldn't be very nice to say that, but, you know, in the back of your mind, you might be thinking that, right? So that's a great question. How do you get a buyer to understand that Credit Karma, it does not equal a mortgage score, right? And we'll talk a little bit about why that is. So FICO gives a lot of credibility to a credit score, right? Okay, and that's because FICO is actually the inventor of credit scoring. That organization is the founding of giving a number to your ability to borrow money. Okay, does anybody know what FICO means? Okay, it stands for the last names of 2 gentlemen, Mr. Fair and Mr. Isaac. It's the Fair Isaac Corporation, okay? They were the guys, they were the mathematicians that came up with this idea of creating a formula that would compute, you know, a score that would indicate whether you would go late, up to 90 days late, within that first year of any lending, okay? And that was sort of how they put that together, okay? And they came up with that late 50s or right around 1960 in that time frame. So credit scoring has been around since then. But it did not come to mortgage lending until the 80s, okay? So if you were like my parents that bought their first home, you know, in 1972 in Stafford, Texas, right? They didn't have, you know, a credit score, right? They took probably a shoebox with their bank statements and pay stubs, right? Utility bills, anything else like that, and down to the bank to see if they could borrow money, you know, to buy a home. So it's a really different process and could be really subjective depending on which bank you went to, right? Honestly. So credit scoring is kind of helping, you know, today to take some of that subjectiveness out of mortgage lending, right? Now, when we see a FICO score, we know that that's a lending score, right? Because FICO is the law of the land when it comes to lending. Auto scores, insurance scores, mortgage scores, credit cards, all use a FICO algorithm, right?
Now employment.
Yes, absolutely. But even FICO has 49 different algorithms inside it, okay? So a credit score is not necessarily a credit score, and a FICO score is not necessarily a FICO score, right? So that means that you've got to understand what type of FICO score it is to really know what it means. If you go to myfico.com and look in there, you know, and you sign up for their service and you pull a MyFICO score, it's going to be derived using an algorithm called FICO 8, right? Which is not a lending score, but it's kind of close to it, right? But FICO 8 is just an informational algorithm, okay? Now within the 49 FICO algorithms, 9 are for mortgages, okay? There are 9 mortgage FICO algorithms, and then there are 3 that are used today. They're called Fair Isaac version 2, Classic 04, and Beacon 5.0, okay? Those are the names of the formulas, okay? And Pilgrim Mortgage is gonna use those formulas, so is, you know, the next mortgage company down the street and the next bank that, you know, mortgage, they're all going to use those algorithms, okay? So that is the equalizer there, right?
How do we know which one's being used? Or does it matter?
Each bureau has its, those three, each one is assigned to a bureau. So
Okay.
when you pull a tri-merge credit report, one, you know, one bureau will have this one, the next one will have that one, right? And they're gonna take the middle of the three is gonna be, right? So that's how that works, okay? Now, these mortgage FICO scores are lower industry-wide, right? You guys know that, right? That a mortgage score is going to be the lowest credit score in, you know, as far as the different industry differences. Now, auto lending, kind of strangely, often has really much higher scores than even like Credit Karma. Insurance has its own perspective on credit scoring because you need, they look at credit to assume risk when they're writing insurance policies, property and casualty, right? Credit cards. Now let's talk about internet because we specifically talked about Credit Karma. And I didn't answer that question at the time, so I wanted to kind of build all this up and talk about this. Credit Karma uses an algorithm that's not a FICO algorithm. So it's not a lending score. It is an algorithm called Vantage with a V, V-A-N-T-A-G-E. When you scroll to the bottom of your Credit Karma, it will tell you the score is derived, and you can show that. You know, let's look at your Credit Karma. Scroll to the bottom. It was computed using Vantage 3.0. That's their latest version of Vantage, okay? The Vantage credit score was actually created by Experian, Equifax, and TransUnion many years ago. And they were gonna try to outdo FICO and come up, yeah, right, exactly, right? But FICO didn't like that. They took them to court and they won. So now Vantage can't be used in lending decisions, period, right? But it's still bought and sold on the internet, right? Lots of sites like Credit Karma, Credit Sesame use a Vantage score, okay? When Vantage first came out, it was really different, like almost like 100 points higher than FICO. Today, on average, a Credit Karma Vantage score is about 30 to 40 points higher than a mortgage credit score, okay? So, if you're trying to explain why to someone who's asking, why is it not the same, right? I would say that a mortgage credit score takes into account the risk of borrowing that amount of money, right? And usually when you explain that way, I think people understand, okay, this is the most amount of money I'm probably ever going to borrow. I'm not going to be a real estate investor, right? I'm just the average guy, you know, average couple. You know, this is going to be our family home. We might buy another one someday, but for right now, this is, you know, this $250,000, that's the most I'm going to probably borrow, right? It's not a $30,000 recoverable vehicle, right? It's not a $1,000 credit card. It's not a $2,500 insurance policy. It's a home, right? So that is a lot of the reason why mortgage credit scores are the way they are, okay? So, does that help?
What's it used for, Karma?
Credit Karma? So,
You can use that
they're
for
marketers.
money for them.
They're marketers, right? Credit Karma is a marketer, right? They market credit cards,
Mhm.
and so they solicit, you know, if you have Credit Karma and you're looking through there, they can tell you, oh, you might qualify for this.
Oh, so
Apply
it's for
here.
their own private lending.
No, it's not their in-house. They're selling ad space to credit card companies while they're generating this.
So credit card companies will use their credit score?
Credit cards, it's a screener, you know, right? They're not necessarily using that score.
Yeah.
But if Credit Karma knows that, you know, hey, someone's score's been trending up, their debt load is getting lower, maybe they, you know, they just bought a car and they've been making payments on time, and so now they've got a nice little 640 credit score, You know, they're gonna send out a message to them, hey, you could qualify for this Capital One card, you know, click here to apply, right? And Capital One has bought that ad space, right?
Okay.
I'm just saying. If you use Credit Karma, then you know, right, that they're trying to advertise to you. And I really don't want to stand up here and say that Credit Karma is bad. Absolutely not. Because if however you're looking at your credit score, whether your bank is telling you or Credit Karma is telling you, if you're looking at it over time, what do you see?
What you're doing.
What you're doing. Changes, okay. Changes mean, is it going up or is it going down, right? So if your credit score drops 50 points all of a sudden and you don't know what happened, right? You can log in to see, oh my gosh, I have a late payment. How did I get a late payment? That was on auto pay. That wasn't supposed to happen, right? Or, oh my gosh, there's a due collection. What is this? I don't understand what this is. I've never bought that. I've never shopped there. What is that, right? So it can help, you know, give you information, right? If you look at it from that standpoint, then it's informational, right? It tells you a little bit about you. And you can look at the trends of it, but just know that it's not a lender's score, not a lender's score. So, okay, now let's talk a little bit about the Mortgage FICO algorithm, about the 5 sections in the algorithm: payment history, the amounts owed, the length of history, types of credit, and new credit, okay? And that's all weighted out there. And we'll break down each one and talk about how it impacts the credit score, okay? So 35% of the credit score is payment history, okay? This incorporates everything that you're making payments on right now, okay? Car loan, boat loan, student loan, mortgage, credit cards, everything that's reporting that you're making payments on, okay? So this is also where all of your negative information is collected, okay? So any late payments, collections, charge-offs, repossession, short sales, bankruptcies, tax liens, anything negative, all calculated here in this largest section. Okay?
What's the charge-off?
A charge-off is when basically it happens a lot in credit cards when it's gone more than 120 days late and the company sells it off to a third party. Yeah. So in this section right here, months of review is really important, okay? So the more timely monthly payments that you make on an account, you tick up that number, okay? 5 months, 6 months, 7 months, 8 months, 9 months. And the greater that number is, the greater that account benefits your credit score, okay? So if you've got a car loan and you've got the 72-month car loan and you're paying on that all the way along, you get to about month 60 and you've got enough cash, you're like, yeah, I should just pay off that truck, right? Get out from under that payment and I won't have to worry about it, right? Has anybody experienced paying off something and your credit score goes down? Yes, yes. So what happens is it drops out of this section. That nice thing that was benefiting your credit score, growing your credit score, and you've made this great financial achievement of paying off that thing, and it is, right? You know, of not being out from under that debt, and then your credit score goes down, right? Shouldn't it be the opposite, right? But a credit score is a funny little thing. It's really based on the credit that you're using at the time. So when the loan officer says, all right, okay, we've got your score where it needs to be, don't close anything, don't pay off anything. This is why, right? Because if you decide to take some of that cash and if I pay off that car loan and I won't have that payment in the thing, right, it'll help, right? No, don't do it, right? Wait until a little bit further down the road and then pay off it, right? Or pay off it at closing, right? Do something like that. So that's important to understand how the months of review. Now, a credit card is tricky in this section. It benefits you, but do you have credit cards that you don't use very often? A lot of us do, right? The just in case card, the vacation card, right? The, you know, in case I need a hot water heater, you know, kind of a card, right? The one you keep in the back of the wallet. that one is not getting a monthly review when it's not having any regular activity on it, okay? So we had a client that we worked with, and he was an authorized user on his parents' BP gas card. They'd had it forever, right? It was a nice, you know, long length of history that they've had this account open, but they never used it. Like, oh, it's just for emergencies, right? So he wasn't seeing any benefit really to his score in this section, even though he was an authorized user on it. So we said, hey, do you think your parents could charge a tank of gas on that card? Oh, no, my dad would never do that. Are you sure? Maybe, you know, take him out for a steak dinner or something. Let him know, you know, a little bit about, you know, how that might help you. And so we did, and Dad charged it a tank of gas, and it gave him a huge boost to his score because it was showing some activity that in that account that had kind of gone inactive. It wasn't closed, but it just wasn't really benefiting him, his score in this section. So it is helpful if you have some of those cards to charge a little bit on them every now and then, or just a trickle of a charge if you've got an ongoing Netflix or your toll tag or whatever it is that you could keep on some cards to keep some activity when you're having that. And it will help those credit cards that you've had for a long time really benefit your credit score, okay? So the next section is 30%. This is amounts owed, okay? So while the previous section, it was everything that you're making payments on, this section right here deals only with revolving credit, okay? Do you know what I mean if I use the word revolving an installment? Okay, so revolving is like the revolving door at the hotel. It's a credit card, right? Money goes in and money goes out. The balance changes all the time. You pay off the balance and you can borrow back against that, right, continuously as long as you keep with the agreement, right? An installment loan, you just borrow a block of money and you just chip away at it, but you can't borrow back on that, right? You can't pay half of your truck loan off and say, okay, all right, I need some new rims and tires, right? And borrow back against that line of credit. You can't do that. You can only continue to make those payments. That's not revolving. So this deals only with revolving credit, okay? So it's based on the utilization percentage. I think people are a little bit more familiar with what that word is. So that's the limit versus the balance, right? So if you have a $1,000 limit and you've got a $900 balance, your utilization is, it's pretty high. It's high. 90%, right? 90%. That's a lot, right? Okay, if you make a big payment and pay it down to about $200, now your utilization is 20%, right? And that's how that works, okay? So the points in this section swing a lot based on balance. And that's when I was talking about how credit cards report on different days of the month, this is why that's a big deal, okay? Because if it's capturing to one bureau on the 1st and the other bureaus on the 18th, it's going to produce a different score if you're using that credit card for your monthly expenses. A lot of people do that. So the way this works is higher utilization is less points towards your score. Bless you. And lower utilization is more points towards your score, right? And if you're over the limit, you get penalized, okay? So that's another thing that you have an over the limit credit card. But the good thing about having an over limit credit card, if there could be such a thing, is that you make a payment and get it under the limit, you get those penalty points back, right? It doesn't go on your credit report like a late payment does, and that just stays there, you know, forever and ever and ever, right? You can get that back into where it's reporting back to where it says, okay? Now, the big part that I really want you to take away here is if you are dealing with anybody who's dealing specifically with a lot of first-time home buyers, young people just getting started, if you don't have an open active credit card, you get none of these points. It's like getting a pizza and only getting, you know, the rest of the pizza, right? 2 slices are missing. It's huge, right? So if you don't have a credit card, you get none of those points. 30% of a max 850 credit score. Do the math, that's a lot. It means you probably can't qualify for a mortgage if you don't have an open active credit card, okay?
Not a Dave Ramsey fan then.
Me?
No, I'm just saying based on that, because Dave Ramsey doesn't like credit.
Right. You're right. And that's confusing, right? But I believe that Dave Ramsey is really helping a lot of people get a hold of their money, their spending. But we have to circle back with some knowledge about the system here and kind of play the system. Like, yeah, I know, Dave Ramsey helped you with the envelopes and you did all of that. That was amazing, right? And keep using the envelopes. But now we're just gonna add to that a little bit of something to help, get the score where it needs to be. In America, in our credit system, this is how it's worked. I met someone who was from Canada, and she's a Canadian citizen, and they live here, and it has taken them years to develop a credit score because they had no debt. No house payment, no car payment, no credit cards, they had nothing. But in Canada, they had an excellent credit score because they did not have debt, right? Ours is based on how you use debt, right? So it's like it's completely opposite. Really different in thinking about that. But it does benefit you to play the system here and understand how it works. So to my Dave Ramsey clients, I say, okay, now let's just temper that with an understanding of how the system works, right? You don't want to be stuck. If you don't have money in the bank to pay for that house today, this is what we're going to have to do, right? Right. And if you think about it, a $200 credit card, if you can manage the payments and keep that under control for a $200 credit card, right? And then get a little bit higher and then a little bit higher, you're showing a sense of responsibility that can, help look like you can borrow larger amounts of money.
Are you a fan of because I've heard people building their credit, the bank cards where they put in the money that's the what? Secured card? Are you a fan of those?
Yes.
Okay.
Yeah, and we've got a recommendation for a really good one, we'll tell you about, so, okay? Absolutely. So the next section here is length of history. So 15% of your credit score is based on the length of history for your open and active accounts, okay? You need 25 years of average credit history to maximize this section, right? That's a lot, right? So a young person, right, that has good open active trade lines is not going to have an 830 credit score, right? Because they don't have the 25 years, unless dad or mom or Uncle Joe has put them as an authorized user on their credit card, right? And then they inherit all of that history. You guys are familiar with how authorized user works? So on a credit card, you can add someone as an authorized user. They don't have to qualify for the credit. They're not financially responsible in the eyes of the credit card. They just have permission to use the card. They can have a card issued in their name or not, which might be important for parents to know. You can add someone as an authorized user, and they don't actually have to hold the copy of the card in their name.
How old do you have to be?
I think you just have to have a social security number, honestly. So we've seen minors with.
Put that newborn on the.
I don't know about newborn,
So they're 25 out of
but
college.
we've seen minors, however, whatever point that you add them, they inherit everything about that card. So when you're ready for them, because you gotta be careful, if you generate a credit score, and if you've got a 12-year-old with a 700 credit score, someone could get their social security, and we know how scamming is big business these days. So I would protect their credit score until you're ready for them to need that credit, and then be prepared to do, right, what you would want them to do. But it would help that young person get a cell phone account in their name.
Or a house.
Or a house, or a car, or an apartment. You need credit for all of those things, or the deposit on the utilities, right? I mean, if you've ever put someone in college and helping them, get started on their own, been there, done that, they need credit for all of those things, right? So that would help, right? So the 800 plus credit scores that are out there, are there because of length of history. And this is where we talk a little bit about a thin file versus a thick file. So if someone has, let's say, only they've got one credit card and a car loan, and that's it, right? 2 open accounts. And they need to access their credit. They need to buy a transmission, or they need to, do something in the way of their credit. When you open a new account, you add a new account with 0 length of history to the average. So your average is going to drop. If you have only 1 or 2 things on your credit report, then that is going to take a bigger hit to the average, right? If you've got a few things that are open and active, 4 or 5 accounts is probably better. Then when you add a 0 to the average, it's not going to affect you as much when you need to access your credit. Does that make sense? Yeah. So like if you have one credit card and you've had it for 20 years, and then you go open a Kohl's card because they talked you into it at the cash register, right? Then all of a sudden, your average drops in half, right? Because you've added a 0 to that total, right? So a thicker file will protect your length of history average. And closing accounts, does it affect your average?
Yeah.
Yes, but is it positive or negative? The answer is it depends, okay? If you're closing your newest account, think about the average, right, in the math, it will improve your average length of history, right? So if you open up a new credit card because you're remodeling your home and you're charging and paying on the tile account, whatever that you bought so you could install your hardwood floors, and then you pay that off and close it, it will improve your average when it's paid and closed because you have closed your newest account and improved this average, right?
Is there a different option than closing, like to get both worlds, like freeze the account so you still get the credit, so nobody scams you?
You can freeze it, yes, but you've got to be careful. There are some revolving accounts that will close due to inactivity, and we see it a lot on credit reports, and people say, I didn't close this, but you haven't used it in 6 months, and so that, especially a merchant store account will very often close. But if you have a Macy's card, they almost never, ever close unless you've done something wrong. We've seen inactive Macy's cards on people's credit reports for a long, long time. So, but a lot of times we get in our heads a kind of an emotional decision, like, you hate the customer service at this so-and-so card, and I've got this new shiny one, and it's got all these rewards, and I like it better, right? So I'm going to close that one and just charge, move all my balance over here, and I'm done with that card, whatever it is, right? Yes? Right? Kind of been tempted to think that way. So we've got to be careful about those kinds of decisions and how they might affect the average length of history, okay? 10% of your credit score is types of credit. So they look at what you have open and just the balance of it. The ideal picture is 3 revolving accounts and 1 installment loan, okay? That's the perfect scenario, okay? Most of us have 2 installment loans, though. We've got a car payment and a mortgage, right? So that doesn't mean that, okay, 2, that means I need to have 3 and 3. I need to have 6 credit cards if I have 2 installment loans. No. I mean, if you want to have the ideal picture, that's the ideal picture. There might be, some drop to your score if you have beyond that, okay? So you can be really negatively impacted by having too many of certain types of accounts. A store account is one of them, okay? So like an Old Navy credit card, a Target credit card, a Walmart credit card, Victoria's Secret credit card, Walmart, just all of those different store accounts, right? We saw a credit report from a client that was coming into our program. She had 25 open active store accounts, and she was using them and making payments on them. She was not late. She loved to shop, and being, growing up, kind of in the southern part of Texas, we like to tease people from Dallas all the time, right? So, we saw that she lived in Addison, which, Dallas is right by the Galleria. So we ribbed her, do you live right by the Galleria? And she said, yes, I do. How did you But she liked to visit the Galleria and shop a lot, right? So her score was being impacted from having too many, even though they were good accounts. So we helped that client to try to get that, penalty sort of off of her credit score, but then also be careful of the length of history, like we previously discussed, right? We didn't want to close some of those older accounts that would help her long-term. So we closed some newer accounts, got this section here back in shape, and then we could also help benefit her length of history. So you can also have too many financial accounts. A financial account is a personal loan, like usually a storefront lender, like Speedy Cash, One Main Financial, Sun Loan. There are a lot of internet companies like you see the commercials for that do short-term emergency loans, that type of thing. Payday loans usually is what we call them, right? They're very high interest, and usually when someone is seeking out a payday loan, there's a risk in the situation. There's some kind of a need, right? So if somebody is opening a lot of these Speedy Cash, and they're always going to, I should stop using that name. But if they're going down to the storefront lender and getting that short-term loan all the time in that cycle, even if they're making the payments on time, what does it look like? Yes, a desperate need for money, yeah. But they're in a habit of going to that, that last ditch effort, right, to get, and it looks like even if they've made the payments on time and completed their agreements, it looks like someone who has money issues. So, so we don't want to see a pattern of too many of those. One is probably not bad, right? It's an installment loan, right? But if you're doing that every quarter, right, then that's the problem, okay? And then the last 10% of your credit score is new credit, okay? And this is because the highest rate of default happens in the first 90 days of opening a new account, okay? So anytime you open any new account, a mortgage, a credit card, or a car loan, you're going to see a drop to your score from this section, okay? Now, over time, those points will come back, right? But they take some points away and just kind of penalize you here for having that new credit, okay? The other part of this section are inquiries, and this is usually a big topic of discussion, right? So there are two types. There are hard inquiries and soft inquiries, right? A soft inquiry doesn't have any impact to your score. So if you're signing up for Credit Karma and looking at your score, that's a soft inquiry, okay? If you're applying for a job and they're checking your credit, it's just a screening pull, right? It's a soft inquiry, okay? A hard inquiry is where you're actually applying for money or credit, okay? And it does drop your score 3 to 5 points. That's 3-5, not 35, right? So if someone says to you, well, that's gonna drop my score. Like my friend, she went down to buy a car and her score dropped like 30 points, right? There's probably another reason why her score dropped 30 points. I'll tell you why. In auto lending, there's something going on there, but it should only be a 3, 4, 5 point hit to their score for one mortgage inquiry. And then those points will come back over time, okay? So an inquiry, a hard inquiry, stays on your credit report for 2 years, but it only impacts your score for 1. Yes?
What about when they're checking with more than one mortgage company?
Very good, like a shopping window, right? Okay, so technically, shopping windows do exist. The CFPB has said that you can, shop around for mortgages, for auto loans, and for student loans within that shopping window period, right? The bureaus differ on this. I would say the safest shopping window is probably that 14 days. You can go on other bureaus as long as 30 days. But to really see a true comparison of mortgage companies, I wouldn't stretch it out for 30 days, right? Because you might see some differences in your score based on information and other stuff, right? Not necessarily just the score, right? So a shopping window does exist. So all of those mortgage inquiries that happen in that shopping window condense to one. So if you're going to 5 mortgage companies, it will impact your score as if it were one, if it occurs within the shopping window, okay? And technically, that's the way it should be in auto lending. But to illustrate that, we had a loan officer partner call us and said, hey, my client just went to buy one vehicle at one dealership, and his score dropped 35 points, and I can't figure out why, right? So what happened is the finance manager sent his information to get him the best rate to 14 different entities, right?
Oh, wow.
The big blast and cast, right? They're trying to get you the best deal, right? Make sure they can, help you out, right? And when we looked at the credit report, there were 14 inquiries on there, right? And 4 of them said auto, so those were in the shopping window and they condensed to 1. The other 10 said financial. And it's because they were with banks and credit unions or other lenders that do lots of types of lending. So when you send an inquiry to, Smith, credit union or whatever, right? How is it coded in the system so they know whether it's a mortgage, is it a HELOC, is it a personal loan, is it an auto loan, right? Because they do all that different type of lending, right?
Are the 10 the same category? Wouldn't it be just one hit for that one?
Fine, there's no shopping window in financial.
It's like a personal loan.
Yeah,
There's
personal
seven.
loans. There's no shopping window there, right?
It's only for a homeowner,
It's for auto, mortgage, and student loan,
student.
those 3.
And do the windows vary? Because that's a question we get with a lot of clients.
I get different answers, and that's a great loan officer question, and let her tell you what she tells her clients. I get different answers from loan officers. Some tell me that 14 days is the safest, some say 30, some say 45 days. I would stick to that 14-day mostly because we know that that is the shortest time there, and then you're going to see the less of just a fluctuation in their scores due to other factors like the other information, okay? So, big picture is that, yes, let's shop around, let's look at some different mortgage companies, but the other thing to remember is they're all using those 3 main algorithms, right? So that they're going to use the same formula. The only thing that will change is your information, right? It used to be back in the day, before 2008, right, that you could go from one mortgage company to another and get a different credit score on the same day, right? But 2008 changed a lot of things, right? There were some mortgage algorithms that were being used before that time that were more lenient, that could get loans done, right? In some cases, maybe when they, when the risk was higher, right? When the picture wasn't as rosy, right? Because they wanted to get the deal done. So the score would, would fluctuate that way. So today, Pilgrim Mortgage is going to pull those 3 algorithms that we said, and so is the next mortgage company down the street, right? The only thing you're shopping for are rates, programs, personality, good fit, right? Some of those others, so talk about those other parts of the lending process, right? And just make sure that it makes sense to work with that company. But the score is going to be the score, right? And that's a good thing to know. Okay.
Real quick, you said it was, the 3 factors were the mortgage, auto, what was it there?
Student loans, shopping windows, yes. Mm-hmm.
Those are boat.
I'm sorry?
Boat. The boat.
No. Not the same as an auto, I guess, because an auto is a necessity, right? You need a car to we expect you to buy a car, right? A boat is more of a luxury purchase, probably, right? Yeah.
Unless you live
Probably, or, yeah, absolutely. Okay, and like we said, the score impact for inquiries is anywhere from 3 to 5 points, okay?
Real quick also, going back to
Yeah.
the types of credits, since we're talking about student loans,
Yeah.
that's obviously
It is, yes. And so a student loan has the opportunity to be something that really can help grow your credit score, right? If you're paying on it for 10 years, a 10-year installment loan could really help build your credit score long-term, so.
I just have people saying, oh, I need to get my student loans down before I can even think about buying a house. But according to this, that's not true.
No,
Yeah.
no. Unless they're not making payments. Right. And that's the thing. So when we talk about collections, we'll talk about student loan collections. Okay, this is a good time just to take a little stretch break. I would invite you, if you haven't checked into the event on Facebook, and like our Facebook page, by liking our Facebook page, we don't spam you, but if you'll see our class, you'll see events. If you see, hey, they're doing another one of those Credit 101 classes, my friend missed it, they're down back at, Pilgrim, or they're down the street, and so it just helps you stay in touch with our company. You can send me a friend request too. I have lots of realtor friends.
Would you like ours too?
Absolutely, I always do. I went to a social media class not too long ago, and they said that you needed to have more than 1,500 friends on Facebook in order to be considered an influencer, and for Facebook to actually put your information out there. And so at the time, before the class, I had 1,450 friends. And so I was like, well, this is a perfect experiment right here. I just need to add a few. And so I did. And then my whole Facebook profile changed, like what I saw and the interaction I was getting from people. So I would say that is a true statement. That when you get past 1,500 friends, your interactions on Facebook and the people that see your posts is a lot greater. So anyway, so use Facebook, and we are we're actually on Facebook Live today, so if you go to our Facebook page, you'll see a little live video, and we're also on YouTube Live as well. It's just a way to kind of get out there. So if you don't know, the restrooms are down the hallway, all the way down. So let's take 5 minutes, eat some more sandwiches.
If you go, 2, 3, 4, 5 is the way to get back in.
Oh, if they locked it?
Yeah, there's a combo.
Okay, all right.
2, 3, 4, 5.
Correct. Just straight down. Skip the one.
Anybody else need water? Looks like you're need water. Okay.
Want any more strawberries?
I'm gonna see what that's one.
There you go.
They want to talk about shopping with you.
Hey.
Shopping with you.
Hi, Chris, this is Kimberly.
Yes.
On 4818 Benzine, and I was just calling to touch base. They said if I wanted to expedite it, to reach out to you. There's a combo lock on the door. If you have any questions, just give me a call back, 210-601-0432.
I gotta get the answer. It's a CFPB that regulates that. So I hear someone can come 14 days, I hear someone come 30 days. I hear someone. So I just, what are you? Oh, absolutely. And then we talked about how.
Do you know Vic Spear?
Who?
Vic Spear. We started about the same amount I did 20 years ago.
That might be because I'm less than 2 years.
Oh. Because I haven't seen or heard anything of it in a minute.
You are with us. You are with us. I like her name. It's my sister. See the resemblance to her?
We all did the same through him.
Yeah, absolutely.
Is this a value add for you guys? You're getting a lot out of it?
Oh, yeah.
Yeah, okay, awesome.
You're gonna show me
I'm still confused.
the contract.
Let us do it for you. Just send them our way.
I just sent a copy.
That's the thing, is that you end up getting just enough information to be a little bit dangerous and misadvised.
Remember her? Yeah. She had it.
To me, it really does not make sense. I'm from Germany. Let's get you have when you buy a car cash, you get a good deal. If you buy it the other way, so it's just different business here. Is Canada, did I get it that right? Canada is what I'm saying?
Does anyone have the experience in Canada? Does Canada use FICO? She was saying that it's better. What are you saying in Canada?
So I met someone who's a business owner from Canada and had absolutely no debt. Nothing. Came to America and had like a 0 credit score. But in Canada, they ordered lots of debt because they did not have any debt.
That's logic of some, right?
Right, yeah. But your score here in our system is based on your ability to use credit, appropriately, right?
So like in Mexico.
Yeah.
You don't have any debt?
Uh-huh.
An excellent credit.
That's how this is showing too.
Yeah, you pay everything cash.
That's a good sign, right?
Yeah.
Yeah.
Money together and then you buy a car. Money together, you buy a credit. But if you don't order money,
Yeah. Yes.
unlike you.
Uh-huh.
That's what's scaring me, because,
Does he want one?
I have a question.
to fix everything, but that's gonna.
Do you establish credit on an LLC, or does the LLC, what you do with the
Are
LLC?
you giving a person?
Yeah, it's an S corp.
Yeah.
Does it give me credit scores?
So this is credit from a whole different animal. There are, so you have a payment school, which comes from Wether, and then there's an Equifax business and an experience. It depends on how you're trying to build your business credit. DOD is more for like vendors.
And I can text it to you.
Order stuff, I'll text it to you.
Because I'm on break.
Equifax is, that's why I call it banks, we're looking at your.
So you bring over.
It's an insurance also. So does that matter?
No, not necessarily, but we had a whole
I
kind of.
just got a small credit card. That's it.
It
Mainly just for tax purposes, but
When you're,
in the name of.
when you're in the business and have to issue the credit.
Chase. Yeah, it was for flights.
I'd be curious to see if that's right.
Stuff, it's under the tax ID.
Okay.
As well, so it's not under the name.
It's almost like, here, go.
It probably uses your personal.
Did you get started from?
Yes, it is.
Yeah.
We were,
But
contract training.
it's a little bit different. I mean, give me a call.
Okay.
We'll go through, how that
One
works.
from India.
I mean, it depends on what you're trying, are you trying to get property or?
Well, yeah, the way I grow organically is
What do you do?
I grow organically, purchasing home and art individually, so you purchase other individuals.
Okay.
So,
You don't do that with
So you
so
need some.
seeing capital
You
purchase.
do the research and
Right,
try
but
to,
you can't do
try to
it.
help.
Well,
Ultimately,
yeah, no,
Yeah.
but you can with the business you're purchasing, like there's already a lot of banks that lend to insurance agents.
I got that when
In other words, there's another choice, like a
You came
traditional.
across that.
Absolutely.
He
Yes,
told me.
but you've got to have a business
Come
credit
across
profile.
pretty
Yeah, okay.
And there's some
Real.
business credit.
It's real.
Crucial. Some of the things that if you have an agency, you probably are doing already about, they say really working by URL.
Oh, that's
So email at
Are you worried that she's not
URL.
gonna go back?
You've not seen this one.
So it looks all that stuff.
It was good, yes, but there's something that lives in 20 lanes. But it's going to look at.
But she's still living on that?
Show that you're bankable.
It looks like legitimate.
Yeah, absolutely.
To see.
Right,
Yeah.
you're not, you're, operations at John's Insurance Company, not John, at John Insurance at Gmail, right?
Yeah.
Right, I
Yeah.
mean, it's that sort of a.
Just consultation broke out.
Can I ask a question?
And a half.
I just got a credit card that
She dropped it.
so if I have another one that,
My chest in it.
so what do you do? But I have it for a long time, so would you keep that? Just use it every once in a while for like $2 or something?
If you haven't already had for a length of time, it's probably really helpful. It's called covered lifetime history average. And if you could look at that and see if your score go down, because it will go with that time.
And how often do you have to use it then, to keep it?
Are
Remind me which one.
Doesn't have to be consistent.
Oh,
The
that
other
part.
thing is, so I know you have
I was
schools
thinking about
supposed to
it,
use
but
more than a
because I
certain
don't have
percentage of your
anything,
credit line.
and the reason I might not.
And
what time is that?
so is it better to pay, you know,
That's
like
the
a
reason I might not.
mid-term before
I
it's
think I'm
due?
living here.
Pay- is that
So,
right?
you know, in
That's my
business
last
credit, it's
deal
really
with the
important to
bank.
pay your invoice as soon as you get it, and the faster you pay it, the more it benefits your payback score.
Okay.
Like if you have a net 30 account and you get the item and the bill and you pay it right away, you're gonna get a higher score than the person who waits till day 30 to pay,
Okay.
right?
It's
But
another thing
in
with the
personal
physical
credit,
thing
it's
that
not
you
that
buy.
way. You're gonna get the same.
You look
score.
at- you're looking at me like I'm crazy.
So business is speed, it's how fast you pay your debts, because you're using the cash to build capital.
So I can walk to your house.
You immediately see profits coming in to
Right.
pay the debt back.
Right, if
Okay.
you're waiting till day 30, then there's.
With personal, it's more of,
15 minutes from here.
you're paying it slowly.
Yeah,
because you're not
you
for
should got
yourself.
that,
Yeah.
that chunk
It's not
of
for
time.
profit.
Right, but in the business world, it is.
Oh, I thought you admitted.
Yeah.
Which is why a lot
Question.
of times, you know, they start you out with the
I don't know
net
if I got 'em here.
15
Can you see if I can catch up?
at first, and then when you show that you pay that on time, when you have the ability to get that 30, that's
That's what that halfway program
accounts, should you use that?
30 miles, yeah, that's half. I can walk there anytime.
Yeah.
Yeah.
So
Okay,
that's
close
only
it.
20 miles, I don't.
Are you just being seen or?
Yeah, watch your financials as well.
We go to
Okay.
dinner together, each other's
Do
house.
very little help,
Very little help?
but mainly,
Let us talk to you about health.
His house is literally that one mile.
I mainly do it
half.
for businesses,
Well, there's no.
and I do 401k accounts for
I get about her.
But I
So
think.
you guys-
Yeah, I have a 66. I don't mess with that, it's a different.
Where are you?
Yeah, and it's another habit that I don't want. Yeah, I would love to talk to you.
Well, let's get started back from our break. Lots of good conversations happening about money and credit and how it works. We're figuring it out. Elevate my scores. Uh-huh. Elevate my scores on Facebook. Okay, so, tell us about shopping windows really quickly.
So shopping windows, right? Everyone wants to get the best deal. So I'm going to speak on it from twofold. One, from a lender perspective, and then because I come from real estate, I'm going to speak on it from what a realtor mental guidance should be. Okay, because they're not necessarily the same thing. From the lender perspective,
Should have done it 5 years ago.
from the lender perspective, there's really not like a publicized timeline. Sometimes you'll hear 2 weeks, sometimes you'll hear 3 weeks. As far as having multiple inquiries within a certain time frame and it being grouped in as one inquiry. So the fable is, and who knows at this point whether it's real or not, it's been diluted so many years now since the housing collapse, but it was something that Obama had implemented. Prior to him, I understand that every inquiry was its own living, breathing thing, but part of his administration was that making a big purchase, such as a car, such as a house, etc., you would want consumers to be competitive consumers and check multiple places, so that was one of the things that he implemented to then group it all together. It makes perfect sense, right? So where does that put you as far as a realtor? So here is something that I would recommend from a realtor perspective, is not encourage shopping. Mind blown? Let me tell you why. Because when you're encouraging shopping, you've got a client that's on the cusp of writing a contract or being ready to go. And you have now sent them down the rabbit trail of go call 5 lenders to see who's going to give you the best deal. And how does that conversation go with those lenders? Did they answer? Is there a callback? Did they get an assistant? Oh, and now they need to go to number 2. And did they get a callback? And they're going to be so frazzled and distracted by that exercise that you'll probably have lost them. They're going to have taken the steam out of their, or the wind out of their sails, because this has now been such a grueling process, right? So what's the other thing? Well, if they do get an answer, what does that answer even mean? So what does a client know to think about, right? Apples to apples. I shop Granny Smith apples at H-E-B. I shop Granny Smith apples at Whole Foods. I know the price per pound. So a client is going to presume that means interest rate. Well, I can do all kinds of smoke and mirrors behind the scenes and translate an interest rate into something really flashy, so I can outpitch the guy that they just talked to 5 minutes ago because they told me they were shopping, and have buried $5,000 in fees, in points. They never asked me about closing costs. And do you really want to get them started on that conversation? No.
I mean, your closing costs? Right.
So, I don't encourage shopping, and it's for that reason. Just like you want to be working so hard for your client, and then your client goes to visit with 5 more realtors, it'll do it at half their commission. I mean, would you want to sell someone else on that, or would you want to be sold on that perspective? Again, it's building a lender relationship that you trust that will do what's in the best interest of that client. So should you discourage shopping? Absolutely not. Should you encourage it? No. For that reason. Just for the logistics, and because there is so much smoke and mirrors, you don't ever know what answer they're going to get. I'll give you an example for a builder. You know, oftentimes we call it extortion, call it whatever you want. Builder's lender. I had a client come to me, shopping rates. So I asked to see the closing costs. They had buried in $3,000 worth of fees that she had no idea about. They called it origination. So that means it wasn't even points that she could have decided, you know what, 3% is a great rate. I don't want to spend $3,000 to get a 2.875. So they even took that choice away from her as a consumer. It was buried in there as origination, not points. So there is a difference in the shopping mentality. So back to the original question, which was the inquiries and the time frame. So the inquiries work a little bit differently depending on the purchase. So a mortgage inquiry and a mortgage inquiry and a mortgage inquiry is grouped as one. If they visit with me today, they go to Ford tomorrow, and they go to Kohl's the next day, it's 3. It's separate transactions, separate subject matters. So when you've got shoppers, again, get them to your lenders, get them to me, so that we can set that expectation of, okay, here's your credit score. Let's not hold it nice and steady. We know what we know. No open accounts or closed accounts. No new inquiries. If you can help it, life happens. If it does, call me. We can talk through it to be proactive and avoid surprises. But that's my thoughts on the inquiries and the shopping. Any questions from the LOPs? No? Okay.
Okay, we'll see you back toward the end, because I'm sure we'll have some more questions at that point. So, all right, awesome. Okay, so let's talk about building credit. How you build credit for if you're a young person, someone starting over after credit repair, what that means. So, like we said, the ideal picture is 3 to 1, right? 3 revolving and 1 installment. Revolving accounts can be secured or unsecured, okay? If your score qualifies you can get an unsecured credit card, right? That means your score is good enough and you're approved for a Capital One card. But a lot of times, if you have NA on your credit report, which means there's not enough information to give you a score, you can't get a credit card, okay? So you have to get a secured card, right? Or if you're rebuilding because your scores are so low, then you need a secured credit card, okay? Now, be very careful when you apply for a secured credit card, right? That you are going to a place that's going to be able to approve you for the score that you have. If you have no score, then you're probably not going to even get approved for a secured card, okay?
What's a secured card again?
Okay, good question. Okay, a secured credit card means you put down a security deposit to guarantee that credit card, okay? A lot of them start as low as $200. You open a little savings account, deposit money there. It's not a prepaid card like the throwaway kind that you get at the grocery store, right? It's not that, okay? To make that distinction, because we did have a client that got the secured card we recommended and thought it was a throwaway card. Charged it up and threw it away and ignored the bills when they came in, and then they got charged off. And we had to help her with all that. Like, oh, I thought that was one of those prepaid cards. Nope, it's a secured credit card. Okay. So not to be confusing here, a lot of companies for secured cards do pull credit, and so they do have a credit minimum. We recommend this company called Open Sky Visa because they don't pull credit. okay? So Open Sky Visa will give you a secured credit card if you have a source of income and a bank account, okay? That's what they're looking for. And there's no hard inquiry that shows up on your credit report, which is great, okay? So you could have a 0 credit score or a 480 credit score or a 590 credit score and still be able to get Open Sky Visa. My oldest daughter just got one several months ago and has been using it and building up her credit that way. So it works. But the best part about Open Sky is that they report to all 3 bureaus. Some secured credit cards don't report to all 3. So you need something that reports to all 3 if you really want to help increase the chances. So like for the clients that don't have any credit cards, and we said, 30% of your score is credit cards, this is usually where we start. Because if you don't have a credit card, likely that your score is in the mid-500s if you've got like a car loan or anything like that. And so we need to get some revolving points on there, but if you go to Capital One, you're probably not going to get approved, okay?
What is the opening initial deposit there?
Open Sky is $200.
There's a local credit union that does the same exact thing, but it's $500.
Do they, oh, it is 500, that's a little bit higher, yeah.
But they don't run credit, they don't do it.
They don't run credit, okay, good, that's good to know. But 500 is kind of high. Then obviously having installment loans could help to build your credit, and this is where we're talking about like a student loan could potentially be something that really does help to build your credit if it's taken out responsibly and paid back responsibly. That 10 years of that installment loan payment could really help to grow your credit score at the time that you need it, right? So it has the potential. You can also do what we call self-reporting. So self-reporting means that, that you send the bureaus information about yourself and it gets reported as an account. You can do that with rent through this service called Rock the Score. In your packet are the links for Rock the Score and Open Sky Visa if you're following along with me and taking notes in the packet. So Rock the Score reports rental payments, okay? So you can have an apartment lease, a property management lease, and it will report those payments to Equifax and TransUnion as an account, okay?
Is it free?
It's not free, it's about $8 a month. And that covers the cost of the communication back and forth with the property manager.
When they do look at your credit to rent a place, is that a hard score,
A hard inquiry?
Yeah.
It very often is, but it just depends on the company. If they have a system in place to do a soft inquiry, I'm not super familiar with that, but it can be. So Rock the Score, like I said, there's a link in the packet, look it up, is for rental reporting. They also have an upgraded service where you can look back to the last 2 years if you wanted, like all of a sudden you've been renting an apartment for 2 years and you've got that data, it will go up and then dump all of that. The other self-reporting that's out there is Experian Boost. If you've seen the commercials about Experian Boost, anybody? Really? I'm shocked. It was even, okay, because it's getting so much press these days. If you just Google Experian Boost, you'll see what I'm talking about. So Experian has their own self-reporting platform now that reports utility payments as an open active trade line on your credit report. And it reports to your Experian report only, not to Equifax and TransUnion. We are cautious to recommend it though. And here's why. Because if you are kind of close in the debt to income balance scales, right? Think like a loan officer for a second, right? And you need a score boost, you need some more activity to help boost your score, and you put a utility account payment on your credit report, now it has to go in the debt bucket because it's on your credit report, right? And it might tip the scales in that debt to income balance that may tip it, too heavy in the debt bucket, okay? Because normally they're not counting a utility payment as debt, right? They just assume that that's a part of the cost, right? They don't, when they're figuring out the debt to income ratio, they don't figure utilities. So if you take a utility payment and you report it on your credit report, now it has to be considered in the debt to income ratio. So there are some programs that are look more strictly at debt load, and that could put somebody out of that. So we're cautious to recommend it. It might help some people. It's not going to help everyone. And like I said, it only helps your experience score. Okay. Now let's talk about credit monitoring. We had this conversation earlier about Credit Karma and what it does and what it means. We really do believe in the power of credit monitoring. You just have to understand what it is that it's telling you, and that it's not a lending, platform, right? So the reason why credit monitoring is important is because 70% of us have something on our credit report that is detrimental to us, that is an error, just a statistical error. If you think about all the names and all the data and all the social security numbers kind of